Well, today I want to talk about financial repression or financial market repression. Now, this is a tool at the disposal of central banks. I'd like to point out that I have a number of videos where I talk about central banks and what they're doing. You can watch those videos if you follow these links right here. So what are we talking about? Financial market repression. Also, in a very broad general term, that means any kind of policy that impedes the proper functioning of capital markets. Now, in practice, what we're talking about is taking a government bond here, which may not be particularly attractive given its lower coupon payments, its lower expected returns compared to other asset classes. You manipulate the market in order to take that bond and make it more attractive to investors. Now, how might we do that? One way to do that is to impose capital requirements on banks. So you say, look, you need to have a certain amount of capital. And not only that, it needs to be in the form of government bonds, at least to a certain percent. It also pass other regulations, for example, saying that pensions need to have X% of their assets in government bonds. Artificially driving up the demand for these bonds. The other thing you could do is put a cap on the interest rates associated with these bonds. Now, the ultimate goal here is to drive down interest rates from where they would be if you actually just let the markets be right here. If artificially driving down these interest rates. Okay. Now, why would we want to do that? Well, one of the reasons we stayed out there is look, we have lots of government debt. If we can drive down the interest rate payments, that would be helpful for governments. As one of the goals of this, here's a chart of the United States. We can see that, yeah, it's the ebbs and flows, but the direction definitely is not going down. The debt is still going up despite some of the financial repression we have seen in markets across the globe. Now, another thing to consider is that as you drive these down further and further, at some point, the interest rates on these government bonds become negative in real terms. When that happens, it's essentially a tax on the savers, on the creditors, and it benefits the borrowers. So it's kind of a wealth transfer in this kind of stealthy tax from the savers to the borrowers. And this number is big. So if we kind of look back over history and do some calculations to figure it out, we see that this financial repression tax amounts to 3 to 4% of GDP. And again, this is done, this kind of stealth tax through financial regulations, and it's, and then it's interaction with actual inflation. This would be in lieu of something that's very transparent, where you through austerity or tax increases. So cutting government spending, increasing government revenues, be very obvious to people. So there's a way to tax people without them quite realizing it. Now, should be clear by now that this is clearly market manipulation by central banks. It's considered very legal for them to do in general. It's not legal for people to manipulate the market. I'd like for you to watch these videos here and think about market manipulation in the context of what we're talking about here and the government's doing it versus what I'm talking about in these videos where individual investors are illegally manipulating the market. That's it for today. I hope you enjoyed that. Think about that. I think it's interesting. Happy trading out there. I'm Brian Kozlowski, and please hit a like, hit a subscribe. Thank you so much.